Welcome, ladies and gentlemen, to Lesson 5, Cost Behavior, Fixed, Variable, and Mixed Costs. In this lesson, we're going to understand the fundamentals of cost behavior by analyzing the behavior of variable cost, fixed cost, and mixed cost within the relevant range. We're going to learn the linear equation method of analyzing cost behavior. We're going to learn the differences between a traditional income statement and a contribution margin income statement, a contribution income statement. And then we're going to go through an example of comparing absorption costing with variable costing. All right, let's start. Have the Lesson 5 cheat sheet in front of you. Have the concept and definition side. We're going to start there. We're going to start at the top left. This cost type, variable versus fixed, we had that in Lesson 1, but it's also relevant to this lesson because we're going to go into a deeper understanding of variable and fixed costs. I won't go through that, but it's there for you to look at. The main thing that we're learning in this lesson that's different than what we learned in Lesson 1 is these things called step cost, step variable cost, step fixed cost, and mixed cost. So step costs are costs that are fixed over some range of activity and then increase in a step-like fashion when capacity limit is reached. A step variable cost remains constant within a narrow range of activity. A step fixed cost remains constant within a large range of activity. And then a mixed cost, a cost that has a variable and mixed component, also known as a semi-variable cost. Alright, so let's go to some types of fixed costs. There's committed fixed costs. These are long-term fixed costs that cannot be significantly reduced in the short term. And then there's discretionary fixed costs that may be altered in the short term by current management decisions. Some examples of discretionary fixed costs include advertising, research and development, etc. So now that we understand those types of fixed costs, let's look at cost behavior. Cost behavior is the way in which total costs change when some measure of activities change. Like we saw with a variable and fixed cost, as our miles driven change, the behavior of the cost changed. For straight variable cost, as activity level increased, so did the total cost increase. For fixed cost, as activity level increased, well, the fixed costs stay the same. So that's cost behavior. We're going to go into more depth in this lesson about the different types of cost behavior. Alright, so let's talk about something called the relevant range, and because as you recall, in the first part of this lesson discussion, I talked about how these, we're going to talk about fixed variable costs, mixed costs, and how they behave within a relevant range. Well, let's discuss what the relevant range is. The relevant range is the range of activity over which we expect our assumptions about cost behavior to hold true. All right, the relevant range, if you look at the top right corner of your cheat sheet, you're going to see this graph. We're going to have cost on the y-axis, activity on the x-axis, and we have this this curved cost function, and that's often used in economics, and that's called the economist's curvilinear cost function. And that what that line or that function does, what it says is, costs change over time. The costs will go up as activity increases, and then it's going to stay flat really as you gain economies of scale, and then it's going to increase. You're going to lose that production efficiency as you put more activity, and so the cost is going to increase per activity unit. Well, you can see that there's this certain range where it's almost linear, or not necessarily flat, but almost linear. Well, that line, that line is what we're going to look at, and that's called the accountant's straight line approximation. And so the economist's curvilinear cost function is almost straight within the relevant range, and that's where we're going to look at the fixed, variable, and mixed cost, because within that we can assume that that line is straight. And why do we want to assume that line is straight? Because that'll help us solve for certain variables if we use a linear equation method. And so the linear equation method is y equals ax plus b. This cost function, this equation, is something that you've seen in your algebra class when you're back in your high school that you've already tried to forget about. Well, it's come back to haunt you, because just like everything else in accounting, where you're trying to make things complicated, not easy, and pretty bland, pretty boring, similar to your algebra class in high school. Well, this function is known as the linear equation in algebra, and there's a slope, there's the y-intercept, the x-intercept. Well, all that stuff we're going to build into our accounting, and the way we're going to build it is this y equals ax plus b, y equals a plus bx. That function, I'm going to define it here. The mixed cost line can be expressed with the equation y equals a plus b times x. This is the algebraic linear equation. Based on this equation, y is the total mixed cost, a is the total fixed cost, or the vertical intercept, b is the variable cost per unit of activity, or the slope, and x is the actual level of activity. Alright, so we've got that equation, y equals ax plus b in this sort of peach pink box. Then we've got total cost equals fixed cost plus variable cost per unit times activity level. Well, that's the written out, y equals ax, where we've written out what those variables equal in this pink box. And then we can change the way those variables are set up, and so variable cost per unit equals the difference in total cost over the difference in activity. Total fixed cost equals total cost minus total variable cost times variable cost per unit times the x, which is our quantity. So that's those three equations up top here, or sort of in the middle above the y equals ax plus bx. A plus bx. Those are just different ways of changing those variables. Alright, so that's sort of the linear equation and cost behavior. We're going to do some problems, and the way we can solve for those problems, there's a couple methods. There's the high-low method. We use two of the most extreme data points, and then we solve for the variable cost, and then we come up with a fixed cost. That was something that you've probably done in your algebra class, but here we call it the high-low method. There's a scatter graph method where we plot a bunch of different data points, and then we sort of, from that, we're going to use the visual fit method where we draw a line, we guesstimate where that scatter graph, where it intercepts the y-axis, and then from there we're going to pick a data point and then solve for the equation. That's something you would have done in your algebra class too, but we're going to do an example of that. There's also regression analysis. That's a statistical technique which you're not going to use because it involves using computers, and I don't think you're going to do that in your accounting class, and we're not going to do that here. But what we are going to do is we're going to have some examples, but before we get into those examples, let's discuss some concepts and definitions relating to absorption and variable costing. Alright, absorption costing, a costing method that charges products with all manufacturing costs, regardless of whether those costs are fixed or variable. The cost of a unit of product consists of all four types of manufacturing costs: direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. Variable costing is a costing method that charges products with only the variable manufacturing costs. The cost of a unit of product consists of the three variable manufacturing costs: direct material, direct labor, and variable manufacturing overhead. Okay, job order costing, process costing, activity based, those were absorption costing methods. We're going to look at variable costing, and then we're going to look at the difference. There's a chart below those definitions, and it graphically represents how the costs are different. We got direct materials, direct labor, variable manufacturing overhead. Those go into both absorption and variable. Where we get different is the fixed manufacturing overhead goes into variable, it goes into absorption but not into variable, and then the variable selling and then the fixed selling go into absorption and variable. The difference is this one right in the middle, the fixed manufacturing overhead, that goes into absorption, doesn't go into variable. Then go up top here, there's this chart that says comparison of absorption versus variable costing, relationship between production and sales. If production is greater than sales, if inventory increases, relationship, so then absorption costs will be greater, income from absorption method will be greater than the variable method. If production is less than sales, the inventory will decrease, then so the absorption income is less than the variable income. If production equals sales, no change, absorption equals variable. When we go through the example on the other side of the lesson plan, that'll make more sense. Now let's get into these charts down here at the bottom, and we'll go through some examples. The first one, go to the red one, step variable cost. So we've depicted graphically the behavior of step variable costs. We've got on the y-axis total compensation of instructors, and on the x-axis we've got number of sailing instructors. So as we increase the number of sailing instructors, our total compensation increases, but it increases at a step. So at one sailing instructor, we've got, say, 25,000. of compensation expense, and we can have that for that level of cost will be the same over the level of activity. It's a narrow range of activity, and the range of activity is the number of instructors. So it's for 1, it's this. For 2, it increases. For 3, it increases a little bit more. But the salary of a sailing instructor is a variable cost. Where it's kind of a fixed. It is a fixed cost in that no matter how many lessons or no matter how much production they have, we're going to pay them their salary, $25,000. So it's a fixed cost. But as we increase instructors, that fixed cost, salary expense increases. But it increases in a step-like fashion, not in a variable or a linear. Well, I guess it could be linear, but it doesn't directly look like a variable cost function. 2, let's look at a stepped fixed cost. Now look at total cost of liability insurance on the y-axis, and then we got number of sailing instructors on the x-axis, and you can see that over a wide range of activities, 1 to 5 sailing instructors, our insurance cost is the same. But as we jump to 6 to 10, that total insurance cost increases. So as we saw under compensation expense, where for a range of activity we had a narrow range of activity, we had a fixed cost, 1 instructor, 2 instructor, 3 instructor. Okay, that's a narrow range of activity. This is more of a wide range of activity where we have 1 to 5 instructors. The expense or the cost in this case is insurance. That's a step fixed cost because it increases as we increase a certain activity level, but it stays fixed over a wide range. Now let's look at a mixed cost per unit. Go to the 3. And we see that on the y-axis we have maintenance costs per lesson. This is maintenance costs of the boats used, or the sailboats, right? So a sailing instructor needs a boat so that he can teach its students how to sail, right? Well, those boats need some maintenance. They're in the water, they need to be cleaned, things can break, sails can rip, keels can get damaged, rudders can get damaged, rudder arms can get damaged, so they need some maintenance. And so this mixed cost per unit, we can see it's similar to that fixed cost per unit in that it starts high and then it gradually flattens out, right? It's got this curve to it. So no matter how many sailing lessons, no matter the number of sailing lessons, we're going to have maintenance on the boats, right? And that's where you see this fixed, or this first data point. You say, no matter if we have 0 lessons, we're going to have, say, $50,000 in maintenance costs. But as our lessons increase, so do our costs increase, but it sort of flattens out because the more lessons we have, we sort of gain, because we would have certain fixed costs no matter what. And so then the incremental additional costs are less if we have more lessons. Because we would have the routine maintenance of cleaning, sails, replacing sails, replacing rudders, but as we have more lessons, well, we can use a sail, we can use a rudder, we can use a keel, we can use all that stuff for a given period of time, but they do need routine maintenance. So as we use it with more and more, the cost per lesson flattens out, and that's what this mixed cost per unit demonstrates. Now look at the mixed cost, total maintenance costs, and the number of sailing lessons. So here we have maintenance cost per lesson. You can see that flattens out. But here we have maintenance cost, which has a fixed and variable component. The fixed component is at 0, we're going to have some sort of maintenance, no matter what, which we saw in the mixed cost per unit. And then here at the mixed cost over sailing lessons, we see no matter what, if we had 0 lessons, we would still need to maintain these boats. Well, then as we increase the number of lessons, our costs increase, but it increase at a variable rate, not a fixed rate. So there's a fixed component, and then there's a variable component, a